Good morning, everyone. Once again, I welcome you all to the 109th session of Zentax Talks. So today we are going to discuss two different topics and also two very important topics. One, invoice management system under GST and another ITR for businesses, which is a very practical topic which will be discussed by our CEO, CAP Aravind Tangam sir. Today, first session, we will discuss the invoice management system under GST. So, I am CA Pavitra. So, I am here to discuss on the topic of invoice management system. So, in this topic, we will cover four important areas of IMS. One is foundation of IMS, that is what is IMS and the GST provisions and what are all the steps and flows through which we should use this IMS. And next we will discuss on the how to use such IMS and how to use that in GST portal. Next is how we will see how the IMS has evolved, that is from its launch date till now, how it has evolved and what are all the changes it has been made. And finally, we will see the compliances, risks and best practices we can adopt in our businesses and day-to-day operations. First, we will see the foundations of IMS. So, what is this invoice management system? This invoice management system was introduced on GST portal from October 2024. So, this system lets recipients, that is the recipient of any goods or services, to actively verify supplier reported invoices before the data flows into their return. That is, before such inputs goes into their GSTR 3B, they can verify using this portal. Earlier, we all know the invoices gets auto-populated in GSTR 2A or 2B, and so through this IMS portal, we have made a shift from passive auto-population to active reconciliation. So the legal basis Section 16(2)AA of CGST Act 2017 states that, as we all know this, ITC on an invoice or debit note is available only when the supplier has furnished such details in the prescribed manner, and also those details have been communicated to the recipient. Only on such conditions, a person is liable to take input tax credit. So this invoice management system is a portal GST portal mechanism that facilitates recipient level action on supplier reported invoices, and it also determines their treatment in GSTR to be subject to CGST rules and acts. So we will discuss all these legal provisions in the upcoming slides. So for the basics, this IMS is the mechanism for that communication. And now for the recipient's response to it. So through this IMS portal, a recipient can give three responses. One is accept, another is reject, and another is they can keep pending of every inward invoices or credit note. This is also subject to conditions, which we will see in the upcoming slides. Now we will see the legal backbone of this IMS, that is, this invoice management systems operates through CGST Act rules and GST portal functionalities. First, Section 37 of the CGST Act, that is, Section 37 of the CGST Act specifies that the supplier shall report the invoices or debit note details in GSTR 1 or through invoice furnishing facility. As we discussed earlier, Section 16(2)AA specifies that input tax credit is available only once those details are furnished by the supplier and those details are communicated to the recipient. Section 38 provides the statutory basis for IMS. So this Section 38 was amended to provide statutory framework for the statement containing ITC related details. So the detailed IMS workflow operates through GST portal and functionality and also through these GST acts and rules. This Rule 60 prescribes how GSTR 2B is generated and how it is aligned to accept, reject, or take any pending action on the IMS. Next provision is the section 39 subsection 1 and rule 61 of the CGST rules. So these two provisions has provided that GSTR 3B for a tax period can be filed only once that period's GSTR 2B is generated and they are available on the GST portal. Moving on, now we will see why this invoice management system is important and why it matters. This invoice management system helps the recipient to claim the input tax credit accurately. That is, this helps in accepting only legitimate verified invoices, which keeps GSTR 2B free of discrepancies in the credit that we claim. Next is this helps to reduce the risk of fraud, that is the ability to verify, and also we have the ability to reject, or we can also flag an incorrect invoices. This will help us to reduce the risk of fraudulent transaction entering the ITC. Next is better control and transparency. Through this invoice management system, the taxpayers gain direct control over the tax reporting by managing the acceptance or rejection, and also by verification on their own. This also helps in providing an improved compliance. That is, this provides greater visibility into supplier reported transaction, and it also helps the recipient to stay compliant, and this also helps to minimizes any filing errors at the time of the monthly returns. Next, we will see how this invoice management system works. So we will explain this in a 4-step flow. First step is the supplier's action. That is, the supplier submits the invoices through GSTR 1 or 1A or through IFF. The next step is the recipient's action. The recipient can verify each record. They can also mark it as accept, reject, or they can keep pending on the IMS portal. Next is the auto population. Once we have given our action, then these data gets auto populated. GSTR 2B is generated on the 14th of that filing date. Then that GSTR 2B flows directly into our GSTR 3B. It also provides for amendments in the IMS portal. The recipient can also revise an action they have taken, but there is a condition. They can revise an action only up to the time of filing the GSTR 3B. After filing GSTR 3B, we cannot go back and change the IMS dashboard for that specific month. Here, an important point to note is that if a recipient has not taken any action in the IMS portal, that is, they have not given any acceptance, rejection, or anything, then the data in the IMS portal, they will be treated as a deemed accepted, and GSTR 2B is generated on the 14th, reflecting ITC, and it flows into GSTR 3B. Now we will see how to navigate and use this IMS dashboard. First step, we need to log into GST portal and we need to sign in using our credentials. Next, we need to go to dashboard, services, and returns. There we will be able to find invoice management system. So once we click that invoice management system, we will be shown at two different views. One is inward supplies to act on the purchases, and another has outward supplies. That is, we can see recipient action on our sales. That is, once we have reported sales, and we can see in that what our customer or the recipient has taken action. So these are all so this is the two sides of the IMS dashboard. One reflects inward supplies and another reflects outward supplies. So inward supplies, here we can see the invoices, debit note, credit note reported by the suppliers in GSTR 1, IAF or 1A. and there we can take action as accept, reject, or we can keep pending. Bulk action can also be taken in that portal. Also, we can reject rejected credit notes are also flagged there. So these data, once on giving acceptance and once we gave compute, these directly feeds our GSTR2B. Another view is that outward supplies. Here we can see how our recipient acted on the invoices on we have submitted. This is only a read-only visibility. This helps us to promote transparency with our recipients. Now we will see what are all the actions available with the supplier. So the first one is accept. So here we can mark the records valid. So this flows directly into ITC available in GSTR2B, and that data gets auto-populated in our GSTR3B. Or we can reject. We can give reject. Here, that once we gave reject, it excludes the record from ITC. The supplier is notified, and they may need to amend or refile. Pending. Once we gave pending, then it shall be treated as we deferred the decision. The record stays on the dashboard until we act within the timelines. As we discussed earlier, if we have not taken any action for an invoice, then the record shall be treated as a deemed accepted for the GSTR2B generation. We will see a practical example on how to accept, reject, or keep pending of the invoices. So in this scenario, a manufacturing firm buys raw material worth 50,000 plus GST from a supplier. Here, the goods are received and they are matched with the purchase order and the invoice details tally. So the recipient can take and give accept in the IMS dashboard. The invoice appears, then this acceptance has to be given before the 14th of the filing month. So once we gave accept, the outcome is the record moves into ITC available in GSTR2B and it gets auto-populated in GSTR3B. We don't need to do any manual entry. Once we gave accept, everything is auto-populated and the accepted ITCs get reflected in our GSTR3B. So this is a scenario where we have a suspicious invoice and we give a rejection. Once we gave rejection, this invoice is excluded from the recipient's ITC. The supplier can review the rejection and take corrective action whenever required. So an important point to note here is rejecting a credit note is very critical. The tax the supplier had reduced through credit note is added back to the supplier's liability in the next tax period. So this specific note we will discuss in the upcoming slides. So when we are going to give rejection, we need to be very careful. We need to assess whether it is our invoice or it is a fake or it is a not related to our business or it's an incorrect invoice, and we need to take action clearly. Another scenario where we can select pending for that specific invoice. So let us take an example. So here a supplier raises an invoice and the goods are in the movement. So the recipient has not yet received the goods, but the recipient can mark it pending until the goods are received and verified. As we know, section 16 has conditioned that goods should have been received. So till the date of receiving the goods, we can mark it as pending. And once we receive the goods, we can later accept that invoices. So once we gave pending, then the ITC stays deferred until an action is taken. So this pending option is available only for specified records or categories, which we will discuss clearly in a separate slide. Now moving on, we will see how this IMS system has evolved in our practical approach. So first, on October 2024, this invoice management system goes live. the recipient can start accepting, rejecting, or hold invoices, and they can also keep pending on the portal. So in September and during September and October 2025, this invoice management system is backed by statutory provisions. So Section 38 was amended and Rule 67B is inserted, and also once after during that period, with the bill of entry and the import bill of entry IGST data also came appearing in the IMS dashboard, and also the pending list eligibility also expanded. So during Feb 2026, there is a dedicated outward supply tab surface where it has mentioned rejected debit or credit note needing liability add back. That is, from that Feb 2026, if a person is rejecting, that is, if a recipient is rejecting a credit note, then that has been added back to the supplier's output liability. So this change has took place during that period, and very recently, that is on April 2020, that is during April 2026, GSTR 3B filing is blocked if at all a person has claimed excess ITC then available in GSTR 2B. So this next is the very recent change which has happened in IMS, which is manual entry in GSTR 3B table 4 is discontinued. That is, we cannot manually enter any data in the table 4 of GSTR 3B. In the ITC column, we cannot manually make corrections or add data. The ITC flows strictly from GSTR 2B. Legal backing of IMS. So as we discussed earlier, the IMS was running on functionality alone, but now it has been strengthened and Section 38 was amended to provide a statutory framework for the statement containing ITC details, the detailed IMS mechanism and treatment of records operated through valid GST provisions, and also GST portal functionality. Now we will see once a recipient gives an option as pending, we can see what are all the invoices and what are all the documents for which are eligible to be covered under this pending action. Beyond the regular invoices, there are 4 specified documents which can also be held as pending. One such invoice is credit note or upward amendment of credit notes. The next is downward amendment of credit notes when the original credit note was rejected. The next is downward amendment of invoice or debit note where the original was already accepted and GSTR 3B filed. And the final option is e-commerce operator document downward amendments where the original entry was accepted and GSTR 3B is filed. An important point to note here is that the above specified records can be marked as pending only for one tax period. So we need to take note of this. So under these 4 scenarios, an credit note or that is the debit note as applicable can be kept as pending other than the ordinary invoices issue. So next step is that once a person has rejected a credit, that is once the recipient has accepted a credit note, now the recipient has to reduce the input tax credit on such credit notes. So they can also that is, the recipient can also declare the ITC amount to be reduced when accepting such records. That is, while accepting a credit note, the recipient can declare how much of the ITC they are reducing and they are reversing for the transaction. So instead of the full value flowing through automatically, they can take up this option and they can mention in the invoice management system portal itself. And another option which another feature which is recently added is that the recipient can also add remarks while taking a rejection or pending action, creating a clearer audit trail for suppliers and internal teams. So they can also they can provide their own remarks, and they can also review it in the future, which will be very helpful for them. Moving on, now we will see how this IMS operates in today's period, that is in today's time. So as we saw, two significant changes have took place in this IMS portal. Now IMS and GSTR 2B play a much more significant role in this input tax credit claim workflow. So the first one is filing gets blocked, that is GSTR 3B submission is rejected at the point of filing if ITC claimed in table 4A exceeds what GSTR 2B reflects. And another recent change is that ITC entry goes fully automatic. Manual editing of table 4 is discontinued. ITC reporting in GSTR 3B is increasingly system driven through GSTR 2B, and it is auto-populated to GSTR 3B, and we cannot manually edit the features in. Moving on, we will see another two important changes in the portal. One is rejected records tab, that is a dedicated tab under IMS outward supplies consolidates rejected credit note or debit note, and also amended records that need liability to be added back to the suppliers 3B. No more manual screening. So this dedicated tab is introduced in the IMS dashboard. And another option which has been made is that offline bulk action tool, that is an Excel based offline utility tool is there, which lets high volume taxpayer to accept, reject, or make pending records in bulk without worrying by entering the records on the portal. Now we will see the compliances, risk, and best practices. The legal, as we discussed earlier, the section 34(2) of the CGST Act and rule 67B of the CGST rules, we need to understand these to access the IMS dashboard and to have a understanding of how it works. So section 34 requires the supplier to establish that the recipient has reversed the ITC attributable to the credit note, where the recipient is required to reverse it subject to the statutory framework. And rule 67B of CGST Act, CGST rules, which is inserted recently by way of notification, it prescribes exactly how a supplier's GSTR 3B liability is adjusted and when IMS shows a credit note rejected. So we have discussed that once a customer rejects a credit note, now we will see how that rejection impacts on the supplier's liability. That is, for these specified records, supplier side liability adjustment may arise when the recipient rejects the following in the IMS. Once the recipient rejects these documents in their IMS dashboard, then it will impact the supplier and their liability will increase. So we will see what are all those scenarios. One is original credit note rejected by the recipient. Next is upward amendment of the credit note rejected by the recipient, irrespective of the action taken on the original credit note. Next is downward amendment of the credit note rejected by the recipient if the original credit note was rejected by them. And the next is downward amendment of invoice or debit note rejected by the recipient where the original was accepted and the GSTR 3B has already been filed. So in these four scenarios, these rejection by the recipient will impact the supplier and this will result in increasing liability for the supplier. Moving on, now we will see what does not flow into the IMS. That is, what data will not appear in the IMS dashboard. First is reverse charge supplies. That is, the RCM invoices received from registered persons are not routed through IMS and continue to be reflected directly in GSTR 2B. We also have to note that RCM on import of services follow the applicable GSTR 3B reporting mechanism and should not be treated as an IMS invert record. And another one which will not appear in the IMS is that ITC which are marked as not available. That is, supplies where ITC availability is marked as no, including ITC ineligible under section 16(4) and ITC ineligible on account of place of supply rules. So these supplies, once they are marked as ineligible, marked as no on their availability, then these will not appear in the IMS dashboard. Now we will see the compliances and risk. The key points which we need to remember is that first is if at all we have not taken any action, then it will be treated as a deemed accepted and all invoices gets accepted, all credit notes gets accepted. Then that will be computed to GSTR 2B and then gets auto-populated in our GSTR 3B. So there is an option in the IMS dashboard where we can recompute GSTR 2B whenever an action changes or if it is taken after the 14th of that month. Next is the once accepted or deemed accepted and rejected records all move out of the dashboard once we have filed the GSTR 3B return. And act on the original record before acting on an amendment. That is, if we have received the original record, then we need to act on that original record before if it is related to the same period, then we can act on the amendment records, or else we should act on the original record only. As we all know, during the initial implementation stage of this IMS dashboard, there was practical challenges. So a recipient may incorrectly, they may accept or they may reject the invoices. This may cause an incorrect ITC in GSTR 2B. Also, once before filing GSTR 3B, corrections are allowed. So we must take prompt actions to avoid any discrepancies. Also, early stages there were errors and incorrect data. So now the IMS portal has aligned, and now we are able to track the data in a very effective manner. Moving on, we will see what we should do if we have made an accidental rejection of the invoice. So there is an advisory, there is a GSTIN advisory on 19th June 2025. An accidental rejection does not necessarily result in permanent loss of ITC. That is subject to applicable timeline and also subject to supplier's correction. That record can be re-reported, and that data we can act upon again and we can claim the ITC. So if at all recipient has mistakenly rejects a genuine invoice or a debit note or a credit note on the IMS dashboard, they can ask the supplier. That a recipient can request the supplier to re-report the exact record. Then the supplier refiles. Thereafter, the recipient can accept and recompute. So we need to be very careful in accepting or rejecting data in the IMS dashboard. We need to periodically review our invoices, and we need to take a timely action on that. Also, we need to keep our documents and records correctly, and we need to actively verify our data. And through following all these mechanisms, we can have a very effective use of our invoice management portal, and we can track our input tax credit, and we can claim the legitimate ITC. So this will enable us to save us from any huge tax demands in future. So I hope the session is very useful. If you have any queries, please mention in the chat box. Now we will go to the income tax session. So in this session, we will cover ITR for businesses, since the due date for ITR for businesses is approaching. So this is going to be a very practical and very informative session. And this session will be handled our CEO, CAP Aravind Tagam sir. So I will hand over the session to sir.
Hi everyone, a very good morning to each one of you. It is extremely a pleasure to connect with you all on this beautiful Saturday morning. On this 8th of August, it is extremely a pleasure to connect with you at this Zen Tax Talks 119, where we discuss something on the very, very relevant and a very current topic, which is going to be for the income tax return filing on the 31st of August. So first and foremost, with respect to income tax, I will just open my PPT and then you can just confirm whether you are able to see the PPT in a minute, please. So the original speaker for the day, CAK Jaimon, has been not keeping well, and therefore I have been here to make this presentation. So this is going to be a very, very practically relevant session wherein we would be talking about what are the common pitfalls which are there with respect to the filing of an income tax return. So what are the key issues to be looked into and how do we really address these issues is going to be the topic for today. I kindly request our members to confirm if you are able to see the screen, if you are able to see my presentation with the title ITR for Business, Common Pitfalls and Key Aspects to be looked into. Is my screen visible, sir? Yes. So thank you for the very enthusiastic thumbs up and a lot of motivation to get this session started and moving. Right. So we start recording now only. Okay. Right. Okay. So now basically with respect to ITR for business, what is it that we are talking about? Is the filing of income tax return already started or is it only now? So let's just look at what are the various due dates that we basically have and how do we really look at things, right? The due date for businesses to file ITR, whether for the financial year 25-26, that is the assessment year 26-27, from the current year, we have absolutely no discussion about this concept of previous year assessment year at all. We are going to be talking about the tax year. But whereas up to the financial year 25-26, we continue to use the words previous year, and most importantly, the terminology under the income tax is with respect to the assessment year 26-27, that is for the year ended 31st of March 2026, whether the due date to file the income tax return for the various businesses is on the 31st of July, 31st of August, 30th of September, or the 31st of October. Let me see some quick answers to see what is the due date for filing income tax return for businesses. Out of these four, we have already options. So out of these four, which is the option that you really think as the due date for filing the income tax return? 31st of August, right, sir? Karthikeyan sir, thank you so much. Is there any other different answer that we really have? Right, 31st of August, right? So we have repetitive answers to say that it is 31st of August. Is it only 31st of August, which is the due date for filing income tax return for businesses? Is there any other due date as well, or is it only and only 31st of August? Out of these four, is it only and only 31st of August? If I really have to look into it, yes, we have depends on turnover, right? Yes. So the answer is not straightforward, absolute, but it is actually a subjective answer depending on the turnover of the taxpayer. Turnover of the business will decide what is the due date for the filing of income tax return. And in that regard, we already had the first due date of filing income tax return, which was 31st of July, which was income tax return for taxpayers not having income under the head business or profession. So generally, until the last income tax return filing season, that is when we were filing the income tax returns during the year 2025, that is for the financial year 24-25, we had all the income tax due dates for all assessees not liable for tax audit on 31st of July. Now, from this year, that is from the financial year 25-26, we have segregated due dates of 31st of July for taxpayers having income other than business or profession. With respect to assessees having turnover generally more than ₹1 crore, the due date for filing income tax return is 31st of October. 31st of August is for businesses having turnover less than ₹1 crore. So as rightly, very clearly mentioned by many of you, yes, many of you have very clearly mentioned business ITR based on turnover, depends on turnover. So very clearly, if the turnover is more than 1 crore, the due date is shifted to 31st of October. If the turnover is less than ₹1 crore, then the due date is 31st of August. So is it only ₹1 crore? But I have put an asterisk mark above ₹1 crore in both the situations of 31st of October and 31st of August. What does that actually mean? Before that, whenever it is 31st of October, the due date is extended. I call that to be the extended due date. That is only and only because that person is liable for audit under the provisions of Section 44AB of the Income Tax Act that falls due on the 30th of September. Because you are liable for audit, the due date of which is 30th of September, the due date of filing income tax return in respect of such assessees is also extended up to 31st of October. So let us now clarify on what is the asterisk mark all about. Is it always about 1 crore or is it any other amount as well? This amount of 1 crore will be extended to ₹10 crores in respect of those taxpayers or assessees having receipts and payments more than 95% through only banking channels. That is, say for example, a business having a turnover or gross receipts of say ₹6 crores, and they are more than 95% of their receipts and more than 95% of their payments is all routed through banking channels, then even in respect of that taxpayer, the IT return has to be filed by 31st of August. The extended due date of 31st of October will not be applicable because that assessee is not liable for tax audit. If any taxpayer, I will repeat, having gross receipts or turnover between 1 crore to 10 crore, so less than 1 crore, always very simple. You need to file the income tax return by 31st of August. About 10 crores, very simple. You need to always have the benefit of extended time liability, that is by 31st of October. But suppose you are falling in between the bracket of 1 crore to 10 crore, then you have one relaxation. That is, you are not liable to tax audit. Once you are not liable to tax audit, you cannot take the benefit of extended time limit for filing the income tax return. You need to comply with the filing of income tax return by the 31st of August. So therefore, the limit of 1 crore is not always absolute, but it is a subjective limit based on the business of each of the assessee. That is, less than 5% is only receipts in cash, less than 5% is only the receipt payments made in cash. 95% of the receipts, 95% of the payments is routed through banking channels. Right? Now moving forward, so in respect of these taxpayers, let us concentrate on this income tax return due date which is falling due on the 31st of August. So for this income tax return which is falling due on the 31st of August, predominantly 3 income tax returns may be required to be filed. Maybe it is required to be filed in ITR 4, maybe it is required to be filed in ITR 3, or maybe it is required to be filed in ITR 5. ITR 4 is the income tax form which is applicable for a resident who is an individual HUO for a firm, not an LLP, where their total income is up to rupees 50 lakhs. They are offering income under the provisions of presumptive taxation under section 44 AD, 44 AE of the Income Tax Act, or 44 ADA as the case may be. Maximum house properties up to 2 house properties. They have other sources of income, but the agricultural income reported or that can be reported under ITR 4 is up to rupees 50,000, up to rupees 5,000. These conditions satisfied, then an individual or a HUF or a firm which is a resident and filing income under presumptive taxation can opt to file ITR 4. ITR 4 is a simplified return. Sugam in Tamil, simple, comfort. A very simplified return in ITR 4 can be opted by these category of taxpayers. Anyone who is not able to file ITR 4, having business income, firm has a separate ITR 5, individual and HUF, less than 1 crore, or taking the benefit of rupees 10 crore limit, which I already explained, 95% of receipts and payments in banking channels, or any of the person having any foreign assets or liabilities, any non-resident, any person having investment in any unlisted companies. You are a shareholder in any company which is not a listed company, then you are mandatory, you are already having business income, then you are mandatory to file ITR 3. You cannot take the benefit of ITR 4. You have capital gains which is accessible to tax at a special rate. Yes, yet again, it is mandatory to file the ITR 3. You are director of a company. Yes, you cannot file ITR 4. You are mandated to file ITR 3. ITR 3, the reporting requirements are detailed, and today the focus of discussion is going to be more about ITR 3, about what are the key fields in ITR 3 and how a person, an assessee, a professional has to duly report the transactions in ITR 3. So when I'm talking about the filing of income tax return, so okay, I'll also explain ITR 5. ITR 5 is talking about an ITR to be filed by a firm or an LLP, society or a trust who is not obligated to file the return under ITR 7. Trust is something, a very separate subject, and we will deal it very separately. But once it is not a trust which is actually filing ITR 7, then they also have to file ITR 5. So the filing of income tax return, which is a voluntary exercise to be done by the assessee, has undergone a very substantial change over all these years. Income Tax Act has been there right from 1961, and it has always been a voluntary compliance which has been there entrusted with the assessee. But very similar to the topic which Pavitra had been explaining to you in the earlier session, which is relating to the invoice management system, which predominantly deals with the claim of input tax credit. With respect to input tax credit, Pavitra has very well explained that input tax credit needs to be claimed based on the transactions which are auto-reflected to you in the statement which is called as the invoice management system. So the invoice management system, commonly referred to as the IMS, has the transactions which are auto-populated to you, and taking cognizance of these auto-populated figures, you are obligated to file your GSTR 3B, reflect your input tax credit or your eligible input tax credit in your GSTR 3B properly, taking proper cognizance of the transactions that are reflected in your IMS. And in your IMS, Pavitra has very much explained in detail that you have the option to accept, keep it pending, or reject the transaction which are reported or reflected as per your IMS. The filing of income tax return has also become a very similar exercise. Rather than merely being a voluntarily filing your or reporting your income, it is extremely very important that you verify, match, and reconcile the transactions that are auto reflected to you. So that is something which is extremely very crucial when you look at it from the perspective of the filing of income tax return, and that is going to be the very important focus as we move forward. So this is a snip from the ITR 3, which very clearly categorizes the assessee based on the turnover limit. Whether your sales, turnover, or gross receipts is up to 1 crore, yes, great. It's between 1 crore or 10 crores, fine. More than 10 crores, right? Good, but then you are applicable for audit. Between 1 crore to 10 crore, the next two clauses, A2 italic 2 and A2 italic 3, very specifically decide whether you are liable for audit or not, and what is going to be the applicable due date for filing the ITR. So, ITR filing is not mere reporting of your income. Say, for example, sir, I have an income to the extent of 11 lakh and 50,000. Not applicable for any of the taxes, because up to 12 lakh, considering the new regime, there will not be any applicable taxes. Sir, I am reporting 11 lakh 50,000. Income tax return requires me to report income tax return 11 lakh 50,000 rupees. Sir, I have duly reported. Am I safe? Absolutely not. Each of the fields in the income tax return needs to be properly given a care of, so that proper reporting is there. Otherwise, you will be having an income tax notice. So therefore, you need to very specifically mention what is your grade of turnover, 1 crore, 1 crore to 10 crores, about 10 crores. And then A22 and A23 very specifically ask whether your receipts, A22 talk about your receipts, your amounts received in cash and other than non-account payee check or bank draft is up to 5% or more than 5%. If your receipts in cash is more than 5%, then if it is falling between 1 crore to 10 crore, then you are required to go for an audit. Thereupon, next, A23 talks about percentage of payments made in cash. If your payments made in cash is more than 5%, your turnover is between 1 crore to 10 crore, then you are again required to go for audit, and you are not required to file it by 31st of August. You can take the benefit of extended due date, 31st of October. First of it, you are liable for audit by 30th September, and then you can go for the extended due date by 31st of October. So selecting these fields in ITR 3 is of utmost importance. Yes, this is all absolute, straightforward, clear. But then moving forward, many taxpayers, we could see, they erroneously select the nature of business in this ITR. This nature of business, which is to be filled in the ITR, many taxpayers, many assessees generally fill other services, not elsewhere considered. Generic other entry. But when there are so many entries specific to the nature of business being done, why is it at all actually important to select the actual service code or the business code itself? Trading, retail or wholesale. The profit margins in each of the business, whether it is retail or wholesale, depending on the sector at which you are engaged with, is completely very different. And when the income tax department is doing a data analytics at an all India level based on sectoral analytics, then if you are not entering the correct business code, then there are highest level of chances that your case may be selected for scrutiny or a notice thereupon, because the code that you enter over here does not reflect the margin that is being actually generated by you. You are required to give your gross profit, you are required to give your taxable income from business or profession, and if this code is not matching with the all India average of sectoral analytics, then you might be ending up in a problem. See, generally, say for example, a wholesale business might have a profit margin between 1% to 5%. A retail business may have a gross margin somewhere between 15% to 30%. So the profit margin will depend based on the place at which you are in the supply chain and the industry at which you are being actually engaged at. Therefore, it is extremely very, very important that you actually select the correct nature of business in the ITR. No account case. In many cases, when I'm talking about common pitfalls in ITR 3, we see that many people generally file or generally fill the details in no account case. That is where it is if regular accounts of business or regular books of account of the business or profession are not maintained, right? Generally, sir, there is no other condition that is mentioned, sir. I will just directly fill the gross receipts over here, give my gross profit, expenses in total, and I give my net profit. Is it sufficient enough? No, absolutely not. Though the specific wordings is not present in the ITR form, if you read through the legal provisions contained in section 44 AA of the Income Tax Act, which talks about the maintenance of books of account, we have the first proviso and the second proviso, which very clearly says, or the section itself very clearly says, if it is in respect of a firm, if the income, the PGBP, that is profit and gain from business or profession, is above rupees 1,25,000, then they are required to maintain their books of accounts. Income is only 1 lakh, but my turnover from the firm is above rupees 10 lakh, then also I am mandated to maintain my books of account under section 44A. If it is an individual or HUF, then if the business is having up to 2.5 lakhs of income, then you need not maintain books of accounts. You can go and report it over here. That is the net profit. Net profit, that is income from business, has to be less than rupees 2.5 lakhs. Business income is 3 lakhs, but your turnover is only 10 lakhs. Then also you have to report. Your business income is only 50,000, but individual or HUF, your turnover is about rupees 30 lakhs. Then also you cannot opt for no account case. You need to give the detailed P&L and balance sheet. So both the twin conditions you need to look into. If your turnover or gross receipts is more than 25 lakhs for an individual or HUF, if the PGBP income is above rupees 2.5 lakhs, then you need to go for a detailed P&L balance sheet. And very similarly for a firm, if it is up to rupees 10 lakhs, you can go for no account case. If it's up to 1.25 lakhs, you can go for a no account case if the PGBP income is all about it. Right? So therefore, don't merely go to fill this no account case just because that option is available in the ITR 3. Do also refer the legal provisions, and that is why you can be properly guided with. So when I say that no account case cannot be generally adopted, you need to give a detailed reporting of your expenses, your income, your assets and liabilities. Let me take you through the form ITR 3 as is available directly from the income tax portal, so that you are clear about how do we really have to share the details, right? I am sharing my screen once again. Sir, is form ITR 3 available and visible on my screen, sir? Yes. Sir, voice is not coming. Is that an earlier issue? Okay. Sir, is my screen visible? ITR 3. So when I look at ITR 3, something that you need to very specifically understand is how do I have to really given my P&L and balance sheet, right? First of it, let me go to my profit and loss account. If it is a manufacturing concern, Santosh, should I zoom in a little bit more? Does it look fully clear now? Okay. So if it is a manufacturing concern, the details of the inventory details, that is opening stock of raw material, opening stock of work in progress, purchases, then your entire wages, direct expenses, factory overheads, your closing stock needs to be fully filled in. If it is a trading concern as well, what is your revenue from operations? What is the sales or gross receipts with respect to goods separately, services separately, any other income separately? What is it? How is the treatment of taxes made in your books of accounts? Closing stock, your details of purchases, your details of direct expenses, taxes on your goods or services purchased. If at all you are dealing in shares, the turnover from intraday trading. If you are dealing in F&O, the turnover from F&O trading. So very clearly needs to be brought in here. Based on this gross profit is what will be transferred to your P&L account, and P&L account should show the details of other income like rental income, commission income, interest income needs to be properly reported here. Agricultural income, then your expenses, freight outward, consumption of stores, power and fuel, rent, repairs to building, machinery, your salaries with a detailed breakup, insurance, whether it's medical insurance, life insurance, keyman insurance, or factory insurance, workmen and staff welfare expenses, your entertainment expenses, hospitality, sales promotion, advertisement separately, commission, whether it's paid outside India to others, royalty, professional fees, hotel boarding and lodging, travel expenses other than foreign traveling separately, conveyance, telephone, guest house, club, festival. Every breakup of the expense needs to be given in utmost detail. How much is your audit fee? How much is the bad debts? If the bad debt is more than rupees 1 lakh, then the PAN number becomes mandatory. So provision for bad and doubtful debts. Each of these items, how much is interest? How much is depreciation? Each of these items needs to be given line wise. Every breakup is captured. So that is where we could say that ITR 4 is more a simplified reporting format. Sir, instead of giving all these things, instead of giving all these items, can I generally say all the expenses as other expenses? Will that be okay? Will that be actually okay? How can the department know, sir? Can the department know how much is my purchases? Can the department know how much is my foreign travel expenses? Can the department know what I have actually reported as sales? Is it only, sir, it is my voluntary compliance. I am giving my details of sales. I am giving my details of purchases. So whatever detail I give, I can give it to the best of whatever I know. I don't have to really worry about why the income tax department will question based on this. They cannot know how much is my rent. Can the department know these breakup? Can the department actually know? That is where we take you through one of the most important forms, which is with respect to one second. One of the most important forms, which is forms AIS. This form AIS, I'm trying to share my screen. Sorry. Okay, so right. So every detail that you fill in your ITR has to be matched with the details available in your AIS or TAS. That becomes extremely very, very crucial. So your GST turnover, which you have actually reported in your GST returns, is very well clearly available in your Form AAS. So income tax return, your income tax portal already knows how much you have actually sold. This sale, which you are now going to report in your income tax return, has to compulsorily match with this Form AAS. If it is not matching, at least you need to have very specific explanations and reconciliation as to why there is a difference between Form AAS and what is being actually reported. If there is a mistake in this Form AAS, you can actually give a feedback, you can give a comment to it. So that is extremely also very important wherever there is a mistake in the details reported in Form AAS. So the sales, you can see there is a turnover of 1 crore and 1 lakh. Not just your sales, even the details of your purchases. So purchases from one specific party itself is 28 lakhs. And the month in which you made the purchase is also being very clearly made available. Therefore, let's take a very simplistic scenario where a person has made a sales of rupees 10 lakhs during the month of March. The purchases during the month of March was rupees 16 lakhs. Basic will tell us that we need to show at least a closing stock of rupees 6 lakhs. And then there would also be the stock already accumulated during the entire financial year. So since the month-wise details are also being made available in the AIS, it is the responsibility of the assessees and equally the professionals who are facilitating the filing of income tax return to properly ensure that the values as available in AIS corroborate, match, reconcile with the details as actually reflected in the financial statements. So every detail as is available in the AIS is of crucial importance and that needs to be properly looked into. If you look something further as well, there is a purchase which is reported in AIS from Joe Solikas to the extent of rupees 54,854. Sir, all transactions that came in my 2B, that came in my AIS, I'm showing you that as my purchase, sir. Sir, this client is doing some other business. Can the purchases from Joe Solikas be claimed as an expenditure in my income tax return? Is it eligible for input tax credit under GST or 3B? If you look at both these situations, you can very well know that with respect to GST, section 16, subsection 1 very clearly says that expenditure which is indirectly in relation to the business in the course or furtherance of business is only eligible for claiming input tax credit. And very similarly under section 37 of the Income Tax Act as well, only and only expenditure related to business is eligible for claiming as a business expenditure. So therefore, you need to look at various important disallowances also when you look at the Form AIS. Any personal expenses which is debited to the P&L account. Joe Solikas jewelry purchase coming in your AIS cannot be made as an eligible business deduction. It needs to be disallowed when you compute. Sir, all these disallowances, whether it will come only when I am liable for tax audit. Sir, only when liable to tax audit, auditor will say that these are disallowed. I am filing the income tax return by myself or tax audit is not applicable. How can it be actually noted by the department? Sir, Joe Solikas, everyone knows it is going to be actually a personal expense, and definitely department having a very good data analytics engine will be able to find out that it is a personal expense. Whether you have disallowed this expense in the income tax computation will definitely be checked into. Therefore, make sure that all the transactions reported in Form AIS are properly verified. Not just personal expenses, but all. I will also just touch about all the other disallowances that would be applicable for a business taxpayer. When TDS is not deducted, the general mindset is that, sir, only when tax audit is applicable, TDS will be applicable. Sir, we already saw a situation where, in respect of an assessee having income between 1 crore to 10 crore, he might not be liable for tax audit, but still TDS applicability will be there. He will be liable for deduction of TDS. Say, for example, payment, say, under section 194C to a contractor, 194J payment to a professional. In all these situations, he will be liable for deduction of tax at source where he has failed to deduct up to the due date of filing income tax return, he can deduct, file, and then he can remit it and also file the TDS return. But he has paid the full amount to the expense. Then he has failed to deduct and then disallowance for TDS non-deduction, where it is a payment to a resident, 30% of such expense will be disallowed. If the payment is to a non-resident, then 100% of that expenditure will be fully disallowed. Then partner remuneration is subject to the limits as provided for under section 40 clause B of the Income Tax Act, where you can pay up to 90% and then up to 60% can only be allowed, subject to whatever is available in the partnership deed. Therefore, it is extremely very important that you look at the partnership deed. The provisions as per the Income Tax Act allow only whatever is the partner remuneration, whichever is lower of all these amounts. Therefore, that is also one of the important disallowances. 48(3), if you had made any cash payments above ₹10,000, then that is also to be disallowed. 43B clause H, where the payment to an MSME supplier is not made within a period of 15 days, or if a written agreement exists within a period of 45 days, then if the payment is delayed beyond 15 days, beyond 45 days, then that expenditure which is outstanding on the 31st of March will become disallowed. Therefore, that is also to be very keenly looked into. Income tax paid is not a eligible expenditure under the Income Tax Act. Delayed payment of employee contribution of PF and ESI. Employer contribution, maybe you can still remit it and then file the income tax return. So these are some of the important disallowances which you need to keep in mind while filing the income tax return. And for each of these disallowances, you need to make sure that you report it in the correct fields in the income tax return as well. So, what is the difference between AIS, TAS and Form 26A? AIS has a detailed breakup. In AIS, you can give the feedback and also give the taxpayer comments. TAS is the summary of AIS, where you have your total GST turnover, you have your total GST purchases. So directly looking at the GST turnover and GST purchases, you can broadly get an idea of what should be their profit. And this will also show the details of investments. Let me also show some slides in the coming slides about how the details of investment is also very clearly reported here. Any outward foreign remittance, any purchase of foreign currency. Sir, I went on a personal tour, sir. How do you know? Sir, it is already reflected in your AIS and TAS. No TDS was deducted. But when you send some amount for your kids' education abroad, then also that gets reported. Your interest from savings bank, sir, savings bank interest and all, I don't have to show, sir. That is all small income, sir. Sir, all those income are reported in your TAS and AIS, and that needs to be properly matched and reconciled. If I say these are my form AIS and TAS, what is 26AS? 26AS is the statement based on which you can take your tax credit. So, how much of prepaid taxes that you consider in your form ITR has to be based on only and only form 26AS. That cannot be based on form AIS or TAS. AIS is only for reference and you can give the feedback. Most important point, values in ITR which are not matched with AIS or TAS will result in a notice under section 144, under section 143, 1A, or you will have e-campaign notices. So therefore, if you feel that any of the information in AIS or TAS is not correct, do give the feedback, because if you are not giving the feedback, it will automatically say accepted by the taxpayer. Therefore, it is extremely very important that entries which are not correct in your AIS, you need to give a proper feedback to it. This is another case of business receipts, where there are business receipts to the extent of 12 crores. There is GST turnover to the extent of 20 crores, GST purchases to the extent of 21 crores. So very simply, you could see that either there is loss in this business or there is a huge accumulation of closing stock. And sir, do you really see that GST turnover and business receipts are two separate entries? Should both these get added? No, that need not be added because both are from different sources. The details of business receipts are the details that are reflecting from your TDS statement. Say from example 194Q, 194H, there has been TDS deduction, then that is coming as business receipts. The GST turnover is coming from your GST data. So a pooled data is what is something that you are able to see in your form AIS. Details of investment in firm. Details of investment in firm. If you have made an investment in any partnership firm, then you need to give the details of it in your income tax return. Many cases where they are reporting only the details of their businesses, but their investment in other firms, their investment in other unlisted securities is not actually getting reflected. But this is a very important field, and all these non-reporting could trigger income tax notices. See, because very simply, in the partnership firm's income tax return, the details of partners are very well reflected. And on the counter side, if you are not reporting that investment in the partnership firm, that will very clearly amount to misreporting. Therefore, suppression, under-reporting. So all those things could get triggered. Therefore, it is extremely very important that if you have invested in any partnership firm, you need to give the name of the firm, the PAN number of the firm, whether it is liable for audit or not. If it is liable for audit, then the due date of 31st of August will also get extended to 31st of October. Then what is the share of profit in the firm? How much is the profit share that you got from the firm? How much is the interest that you received from the firm? How much is the remuneration, partners remuneration that you received from the firm? How much is the capital closing balance as of 31st of March? All these details you need to report it in the ITR. Details of investment in unlisted securities. This is also a very important reporting which many people miss, and these could also trigger income tax notices. What is the name of the company? What is the type of the company? What is the PAN number of the company? Opening balance, beginning of the year, how many shares that you have? What was the cost of acquisition? How much of shares you acquired during the year? So when was it acquired? What was the face value? At what price was the share issued? So what was your purchase price if you are purchasing it from other shareholders? If it was new issue, fresh issue, then issue price. If you are purchasing it from other shareholders, purchase price. See, many situations where people are buying shares for investment, not just for investment, and also merely for group captive power purchase. These are also investment which you need to actually report in these respective feeds. Investment in unlisted securities, where shares are transferred, these shares are sold. So then how many shares were transferred? How much is the sale consideration? So closing balance, all these things needs to be very clearly reported in your ITR. So these are some of the common pitfalls that we could see where people are not reporting and then getting income tax notices. Details of virtual digital assets. Now, many people have started investing in crypto, and these transactions of virtual digital assets, say for example, someone is investing through the WazirX platform. So all these crypto platforms, these transactions are also getting reported in your form AIS, and this income needs to be properly also reported in your ITR. So these crypto transactions, you have a separate form, separate table for reporting of your virtual digital assets. It is extremely important to note that every transaction with respect to crypto needs to be reported. It is not that I can consolidate the entire year's transactions. No, because loss of one crypto sale transaction cannot be offset against this gain of another crypto transaction. Every line of transaction, you have a very specific field for date of acquisition, date of transfer, which very clearly says that transaction level details needs to be given, not the consolidated details of the entire year. Therefore, you can add any number of rows, each of these slides, and whether it is your business income or whether it is your capital gain, that needs to be properly selected, and based on which that business income or capital gain will get automatically reflected. So what was your date of transfer? what was your cost of acquisition, what was your consideration received. So depending on that, whatever is your income from transfer of virtual digital assets, even in case of transfer from one form of crypto to another form of crypto, is also considered as a transfer of virtual digital assets, and that will also trigger an income. Therefore, it is extremely very important that these transactions of virtual digital assets are also properly reported. Shares and mutual funds. Many people say that, sir, those are personal investments, sir. Why should I report it in my business ITR? Sir, if you are individual or a HUF, then your business ITR is the same as your individual ITR as well. Income tax return is filed for a PAN, not for your business alone. Therefore, whatever transactions of investments as well also needs to be reported whenever it comes to your income tax return, and these transactions which are available and reported in your AIS needs to be properly matched, reconciled and verified. So each of these sale transactions are there available, and only whether it is my details of sales, no, even my details of my cost of acquisition is also being made available with respect to my form AIS. Whether I sold it in short term or long term, what was my sale price per share, what is my total sales consideration, what is my cost of acquisition, so what is my capital gain is something which I need to calculate. When I come to this calculation, in many situations we could see that many people are reporting disproportionate investment into shares and mutual funds, but their income reported is extremely very negligible. Sir, how much profit did I earn? Sir, my business profit, sir, let me show a profit of only rupees 8,50,000. Great, 8,50,000 is your income, but your total investment in shares, mutual funds, fixed deposits, which is reported in your EIS during this year itself is rupees 35 lakhs, sir. How could you be reporting your income as only 8,50,000? Sir, 35 lakhs, did I make an investment in this year only? Yes, sir. All are fresh investments. Even if you are closed and open, then give me the details. That needs to be properly verified and reconciled. With respect to sale of shares, one important aspect that we could practically see is that where the profit and loss statement given by your broker considers your STT paid as an expense, but whereas under capital gains that is not allowed as an expense. Therefore, you need to properly verify your AIS with your broker statement, compute the profit or capital gain as per the income tax provisions, and then duly report it. Cost of acquisition may be incorrect in some situations where the acquisition is made before 2018. Then cost of acquisition may be incorrect. Then report those in your AIS. Agree income and exempt income. Sir, many people have some practice to say that only if it is taxable income I need to be worried about. Let me just report agree income. Let me report agree income of say 18 lakhs. When I report agricultural income, if the agricultural income exceeds rupees 5 lakhs, then you need to give the entire details of the land, the district along with the PIN code in which the agricultural land is located, what is the measurement of the agricultural land in acres, whether it is owned or leased, whether it is irrigated or rain-fed. This detail needs to be very specifically given when it is with respect to agricultural income. Any other exempted income also, be very careful when you're reporting exempted income, because for all your exempted income, there will be questions on how you got that exempted income. Details of foreign assets and income from any source outside India. This is also a very important field basically when it comes to your ITR. Many people are not fully reporting the details of your foreign assets and income, but the details of bank accounts wherever you are signatories, details of immovable properties, details of beneficial interest that you hold in other securities, all these things of foreign assets and income also needs to be reported. There are very detailed fields for reporting your foreign assets and income also in your ITR. You need to carefully go through it. So these are some of the very important aspects which we felt are very important when it comes to the filling of ITR. So now the ITR season is due. Best wishes from the entire team of Zentax Clinic and Paul & Arvind LLP with respect to the ITR due dates coming forward. So if you have any clarifications with respect to the ITR due dates, we would always, with ITR due dates or the applicability as well, we would always be glad to receive the same. Any questions you could always mail to us or send it to us through our WhatsApp numbers. If there are anything else, we will take it up further on. Session which was planned till 12 noon has already got extended by 12:25 for want of time. We will close the session here. It has been a very enthusiastic participation on two topics, both together on income tax and on GST. A special thanks to Pavitra for taking us in depth through the concept of IMS. A pleasure to have interacted with you. Looking forward to your active participation in our upcoming session. Thank you, one and all. Thank you.